Hi folks, David Waring here again with InformedTrades.com and our third and final lesson on the subprime financial crisis. Now that we understand exactly what a subprime loan is and exactly how these loans are packaged up and resold around the world, we can now take a look at exactly how the financial crisis happened. In late 2004, the Federal Reserve under Chairman Alan Greenspan at the time started to raise interest rates pretty aggressively from their historic lows of 1% all the way up to 5.25%. Now, several things happened as a result of this. Firstly, it became more expensive to buy a house because the mortgage payment for the same price house as interest rates rose went up pretty dramatically. Okay? And this basically caused the real estate market to begin to slow down, and people who are used to seeing their house value increase by 10 or 15% a year started to see their house price not increase at all or actually start to fall off moderately. If you remember correctly from our first lesson, a lot of the subprime borrowers took out loans that they could not afford because they were planning on using the increase in value in their house before these harsher terms of those loans kicked in to refinance those loans so they wouldn't have to pay the higher payment once those harsher terms kicked in. So because the real estate market slowed as a result of these rising interest rates and some other factors, they've now caught in a situation where they could not refinance and get another mortgage to replace the one where the harsher terms were. So they're in a situation where they basically have to pay a much higher mortgage payment that many of them cannot afford. Because of this, a lot of the houses of a lot of these subprime mortgage holders, they're starting to default or not pay their mortgage payment, and therefore their houses are being foreclosed upon. And there's now billions upon billions of dollars of losses related to this. As the subprime portion of these mortgage pools were defaulting at a much higher rate than expected, the financial institutions which held those pools stood to lose a lot of money as a result, hundreds of billions of dollars actually. And this created what's known as a liquidity crisis, because the problem would be bad if everyone knew who held those loans and how much exposure they had to them. But if you remember from our second lesson, these loans have been packaged up and sold around the world to all sorts of different financial institutions, so nobody really knew who exactly held a lot of exposure to these subprime loans and how much they stand to lose as a result. So because of this, it created a situation where no one trusted each other. Even the largest banks in the world were skittish about loaning money to each other. And this is a real problem, especially for these banks, because they basically are the financial system, and they rely heavily on short-term loans that they normally get at very low interest rates to fund their operations. Because these banks are so large and considered normally very creditworthy, they normally, and these are short-term loans, they normally get these loans for very low interest rates. But because of this problem, everybody was so skittish that the interest rates that were being charged on these overnight loans went through the roof. So this is why you read about the Federal Reserve and central banks from around the world stepping in and injecting billions of dollars into the financial system to try and avert a liquidity crisis, so to speak, and keep the financial system moving and keep it from locking up where nobody would lend money to anybody else. If you also remember from our second lesson, we learned about something which is known as a structured investment vehicle, which is basically a huge pool of pools, so to speak, that holds a bunch of these mortgage-backed securities. If you remember from that lesson, we learned that these entities fund their operations by borrowing money on the short term and then buying this longer-term debt. And if you remember correctly as well, they have to continue to refinance or continue to roll those short-term loans over to continue to be liquid and to continue to be ongoing entities. So you can see where the problem arose there, because as the interest rates on these shorter-term loans went up and as this crisis unfolded, these entities were no longer able to get loans on the short term anymore to continue funding their operations, or the loans that they were able to get were at much higher interest rates compared to what they were having to pay before. And this is why you hear about banks like Northern Rock having to be bailed out by the Bank of England, and banks like Citigroup having to raise $11 billion from the Abu Dhabi Investment Authority. So because there's so many problems with the subprime portion of the mortgage market, The mortgage market in general, the market for asset-backed securities and mortgage-backed securities is basically dried up in a lot of sections, specifically for entities that or securities that hold subprime debt. So if any of these organizations or banks or financial institutions that are holding this debt are forced to sell, the market is basically not there. So there's not a lot of willing buyers of this debt. So this means that if they are forced to sell, they're going to have to do so at a much lower value than that security is probably worth, even with all the problems that we're experiencing right now. Lastly, and probably most importantly related to that, is because there's no market for these securities, nobody really knows how much they're worth. So even for the banks and financial institutions that are coming clean and saying, hey, this is how much subprime exposure we have, and this is how much we're writing down or how much we expect to take in losses as a result of our subprime exposure, even for those people where we know because they've come clean, there's still a lot of suspicion surrounding exactly how they came up with the numbers and how they valued how much money they think they're going to lose as a result of this. Currently, there's still a lot of uncertainty as to how bad this is going to be and how long it's going to go on. All I can say here is that time is going to be a very key factor. The sooner that these banks can come and financial institutions can come to an agreement on, or some sort of standardized way that they're going to plan on valuing this stuff that the market believes in, and the sooner that everyone comes clean and we know where all this debt lies, the better that things are going to be. If that process is wrapped up by the end of the first quarter of next year, although that's going to be pretty painful in the short term, I would anticipate that things would be much better in the long term. If it goes on much longer than that, then I'm expecting things to be pretty bad for quite some time. So that's our final lesson on the subprime financial crisis. You should now have a good understanding of how all this unfolded. If you have any questions or comments, please feel free to leave them in the comment section below. And have a great day.